deep in the heart of Mont-Royal. The old tunnels being used for trains from the past are being restored, and a modern line is being built. A change in fortune for Canada's economically battered metropolis. But the return to the subway scene of Montreal is more than just the system. It's also the way the system was built. So how did this have-not city, traditionally plagued with financial issues and corruption, achieve this? Well, the answer is innovation. No, not what you'd normally think of. Management and financing innovation. During the financial crisis, the second largest pension fund in Canada, the CDPQ, or CASE, noticed something nerdy. While most of their investments had tanked with the rest of the market, their infrastructure investments had been rock solid. The pension fund was heavily invested in Vancouver's airport transit line being built for the Winter Olympics. It was a public-private partnership, and their role was the rich relative with money helping out their often troubled Quebec brother SNC-Lavalin, who were overseeing construction. The project went well. The public got their line, the pension fund started getting returns for Quebec's retirees, and most Vancouverites don't even know that it's operated by anyone different to the other SkyTrain lines. That was a big W, I tell you! We should do that again, said their staff. So they decided to pick up some more infrastructure investments. But they were not alone. A lot of other large institutional investors had done well in infrastructure during the financial crisis too, and a limited number of investment spots in infrastructure was snapped up. I mean, most North Americans will agree, we haven't been doing a great job of building infrastructure lately. There just weren't enough projects looking for a rich relative. The case picked up its money bags and headed home. But this is where something unusual happened, because its home was Quebec.
Je n'ai plus d'opinion. Je m'occupe de mes oignons, les deux mains dans la terre et la tête en l'air.
A province with an appetite for political ventures and unorthodox structures. The largest city of the province was Montreal, a town with several engineering and construction firms that had mostly allowed its transit to run on the fumes of its former glory. While Montreal had struggled with corruption, economic stagnation, and population decline, its peers had gradually taken the transit lead. In a meeting with the government, they learned that there was an interest in getting some long-dreamed-of transit projects done finally. But they didn't just sit around with their bag of money waiting for some engineering firm to come knocking. They set up and staffed up an infrastructure division near the major construction and engineering players in downtown Montreal. A group of people that can manage a project, not just write checks. With the support of the Quebec government, they asked the various municipal and government stakeholders in Montreal what transportation problems they were looking to solve. They found out there was an interest in connecting the South Shore and the airport, as well as reducing the amount of traffic on existing metro lines. They also figured out what opportunities they had. The proposals for the new Champlain Bridge being built had light rail in the project. Could that be used? There were all these highways where people wouldn't mind cheaper above-ground infrastructure being built, and there were rail corridors that were underutilized. They also found out how much the government was paying for the bus and train services that currently solved the same transportation problems. They then put all of that together and came up with a better solution for the government at a better price than they were currently paying. It's kind of like if someone came to your street and asked you and your neighbors, how much are you paying for internet? And then they went away, figured out what it would cost to set up fiber optic, and came back to your house and said, okay, we can give you twice the speed for half the price if you and your neighbors all agree. It's pretty much that simple. Actually, it's not. It took them like the better half of a decade to figure this all out, but that's the gist of it. So, as an example, in 2018, there was a heavy rail passenger line going to Deux Mountains with an average cost per passenger kilometre to the Transit Authority of 89 cents. It would run 9 trains in the morning and afternoon from open platforms through the Mont-Royal tunnel to downtown. By retrofitting the existing tunnel and building down highways, they managed to come back to the city with a deal for a 20-hour-a-day, 7-day-a-week automated line. Instead of 9 departures during the rush hour, there are 40. People don't need to carefully plan their day downtown and make sure they get back to the station at a certain time before the last train leaves. They can just wait until bar close and head to an enclosed, now air-conditioned station. The train will show up in minutes. And what's best? Instead of costing the government 89 cents per kilometre to operate, plus construction and new equipment costs, it costs them 72 cents. all included. This looked great. I mean, the only people who were unhappy were the train guys who dreamed of steam. In order to make the project happen, the case kept things on the down low as it negotiated with all the various parties. It needed expropriation laws in place to acquire land for stations, so those were passed in 2017. Believe it or not allowing companies building transit systems to acquire land is a common cause of project failure. A transportation tax was set up so that property developments within 1 kilometre of new stations would fund the existing Regional Transit Authority, the ARTM. The ARTM pays the 72 cents per passenger kilometre to the case. This kind of handed the long-term power over to the ARTM that comes with having the purse strings. They also had the task of giving feedback and integrating the REM into the existing transit systems. So what are the risks with this project? The project's $6.9 billion in funding comes from loans from the Quebec government, the federal government, and Hydro-Quebec. The case takes the largest stake and risk. For the average Montrealer and the City of Montreal, the project's cost doesn't really matter. It's kind of like being a renter in someone's house. I mean, it's interesting to know the house's value and price, but in the end, you just have to know that rent is 72 cents per kilometre. Your ticket on any transit is already highly subsidized, but less so on the REM. The cost, risk, and overruns are all mostly the case's problem, and a bit of the Quebec and federal government because they're supposed to get paid back one day too. But for the city, we just have to pay that subsidy, as per usual. If ridership ends up being very low, the case are the biggest loser. They're motivated to make the system as good as possible and get as many riders on it as they can. There is no minimum payment. If no one rides the REM, the city pays absolutely nothing. Although it's probably the end of the world, so I doubt people will be worried about transit project financing models at that point. As ridership increases, the price per kilometre the ARTM has to pay decreases. So we won't be punished as a city for growing and increasing our population. In fact, this incentivizes densification and growth. And this is the thing which I think people, when discussing the REM, always forget. If we as citizens ever feel ripped off, if it becomes an infamous, oh man, that thing, it sucks, we're stuck paying for it. The case is a pension fund created and regulated by the Quebec government. The law can be changed and the case can be forced to, say, sell off its assets to the city at a reasonable price. And if the city were to acquire it, even at a price twice that of construction, it would be a great deal. It was an incredibly efficient use of money on a system that will have a very low long-run operating cost. So go ahead and screw up, case. Really looking forward to getting our hands on that. Of course, the case don't want that to happen. They want to export this model and do it in other markets, which is not going to happen if they're infamous for screwing over their hometown. This grand vision to make Montreal a hub, not just for building our own transit, but for building other people's transit, is pretty wild. The case had a reputation for being a boring institutional investor, and when they started doing this, heads turned. There is something very Quebec about a state-owned enterprise with oddly huge ambitions to change society and the world. Bringing the conception stage vision and the money and the management could make this pension fund, of all things, one of the most, if not the most formidable transit builders on the continent. The deal sounded good to all parties involved, and the final version was signed in 2018. With the proposal accepted between the big names of government and industry, millions of citizens finally got a chance to see what had been decided on for them. And there were quite a few questions. One group with a lot of them were the millions of Quebec pensioners. Was this a good way to invest grandma's retirement money?
We intend to go further. We intend to export this model. Quebec is not alone in the world in needing to build new critical public infrastructure. Governments in the rest of Canada, in the United States, in Europe, all face the same needs and the same fiscal constraints. This model can and will help to meet their needs. And in so doing, It will open new markets of opportunity for La Caisse, for our partners, and for our depositors.